Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about how many properties do you think you need in order to fund retirement? Obviously, that's investment properties. And of course, the answer is going to be different for everyone. It's going to depend on their income and existing assets and time until they would like to retire or at least reduce working hours, their goals and lots of other factors. However, I've been involved in developing hundreds of investment strategies, possibly thousands, and I can tell you that 90% of the time, most people only need to hold somewhere between 1 and 2 investment grade properties. So it's quite unusual that I will recommend 3 or more investment properties. The key thing here is quality, not quantity. And quality trumps quantity every day of the week. In fact, I would say quantity is a meaningless measure. You know, I'm not impressed that someone can acquire 5 investment properties. It means nothing if those assets are of a poor quality because, as I said many times, you cannot expect above average quality returns from either average or below average quality assets. It all comes back to the quality of assets you invest in, and I would much rather hold one awesome quality property than 10 very average ones, or even 10 slightly above average ones. That one awesome quality property will reduce your risk as an investor and increase your returns, compounding returns, in the long run. Now, over the years, I've read books, seen property promoters, I've read advice from other advisors and heard other advisors advising investors that they do need to, in fact, acquire a significant property portfolio in terms of the number of properties. And quite often it's a sales pitch. You know, they're going out and buying the properties, and of course, you know, if they advise you to go and buy 10, there's a conflict of interest there. There's a benefit for them to do that. But I fail to see how it's actually going to work. You know, if, let's say 5 properties, how are you going to actually do that? You know, the first thing is that if you need to acquire 5 properties, it's probably likely they're going to be lower value properties. You know, most people can't afford to go out and buy 5 $1 million properties, of course. That's $5 million a property. Probably closer to $6 million of lending, including costs. You know, not many people are going to be able to afford to do that. So therefore, you're going to have to reduce the purchase price. So they're going to be lower value properties. And therefore, you're likely to compromise on asset quality. And there's no solution or no benefit in compromising ever on asset quality. If you're going to obsess about anything with respect to investing, if there's going to be anything I can teach you through this podcast, is it's all about asset quality. The second problem with the strategy of multiple properties is the amount of debt that you have. So quite often I've seen profiles in property investment magazines of people acquiring a whole bunch of property in a very short period of time, and they might have $2 or $3 million of loans on a pretty modest family income of maybe $100,000 or $150,000. You know, it's a very high risk approach, and in fact, I think it's probably something that's going to be very difficult to implement these days, given the tightening in credit over the last 1 or 2 years, which isn't necessarily a bad thing. You see, when it comes to debt, we need to have a debt exit strategy. We shouldn't be taking a lot of debt into retirement because we're going to be very sensitive to interest rate increases at that time. So that is that if we have a lot of debt and all our income's coming from investment income, and that could be from super, which is dividends and interest, or it can be rental income, if interest rates increase by a few percent, that doesn't translate, or our investment income won't increase by the same amount. So we'll be very sensitive to interest rate increases in retirement. And therefore what we want to do is either take very little debt or very conservative levels of debt into retirement. Now, if my strategy involves going about borrowing $3 million today, how am I going to get rid of that debt? And that's one thing that we need. Whether you're buying 1 property or whether you're buying 5, you're going to need to consider about your debt exit strategy and how that's going to integrate in with retirement. Now, you might be able to reduce debt by just offsetting debt through cash flow management. So using your surplus cash flow between now and retirement and gradually repaying debt that way. You might sell some assets, so sell one property and keep one property, for example, or you might draw a lump sum from super, or do a combination of all those things. There's many ways to achieve, debt reduction, but my point is you need to consider how you're going to do that. And more importantly, buying more properties or borrowing more money doesn't necessarily get you closer to retirement. Of course, again, it depends on how far away you are from retirement. If you're 30 years away from retirement, your debt will start to become immaterial just through the capital growth of property, assuming you're investing in the right assets. So if we're not going to go and buy 5 properties and we're only going to buy 2, maybe 3, what are the things that you need to consider? Firstly, obviously, the overwhelming thing is quality. But then in terms of constructing a property portfolio, you can spread your risk and hopefully smooth your returns by astutely constructing your property portfolio. So there's 4 considerations, I believe, that you need to consider when constructing a property portfolio. So the first one is diversify geographically. Secondly, diversify across different price points. 3, diversify your tenant profile. And 4, invest in a location that's going to be different to where your home is located. So let me talk about each of those independently. So diversify geographically, which is really spreading your properties among different suburbs or market segments, or even consider investing in other capital cities, so outside your domicile capital city. The thing is, and you've probably read it or seen it, heard it many times, is that the property market isn't just one homogenous asset. It's really made up of really thousands of different property markets. Different suburbs are going to perform differently at different times, and even different pockets in different suburbs and different types of properties in that same suburb will perform differently. So what you need to do is understand or identify the value drivers and the demand drivers in those different locations, and then try and diversify from that. So not go for the sort of same demand or the same type of property or the same sort of almost culture of a particular area. And the benefit of that is you're spreading your eggs. That they will perform differently at different times, so it won't be uniform growth. But at a portfolio level, hopefully what you can do then is smooth that growth. And then enjoy some equity appreciation more consistently, rather than putting all your eggs in one basket. Diversify across price points. So don't buy the same property at the same price point, because you're probably going to buy again the same sort of type of property. High value properties sometimes grow at different times than lower value properties, which will be dominated mostly by first home buyers and so forth. So again, you want to sort of spread your eggs. Same with diversifying on tenant profile. So that's really goes to how much you're receiving on a rental income basis. Now, the lower the amount you have, you don't want to put it too low, because then you're probably buying a lesser quality asset. But obviously, a lot more people can afford to pay $400 a week as opposed to, say, $1,500 a week. And so you get to reduce your risk and risk of vacancy or longer-term vacancy by really spreading that risk and not having, it's great to have one really high-value property, for example, but then you would mitigate some of that risk or diversify some of that risk by adding a lower-value property to that in that portfolio. And then my last point is really diversifying from the geographical location where your home's located in. Now, I get that we buy homes for different reasons and they're not investment assets. However, as a bit of a plan B or plan C, if everything failed but we did still have a lot of equity in our home, that's still going to help us in retirement and give us some opportunities. So my view would be then diversify from that. If you've got a house in a particular suburb, don't necessarily go and invest in that suburb. In fact, I'd be thinking about, in your capital city or your state, where else could you invest in that's actually quite different to the home, to the location of your home. Which is a good segue into another point, which is what I try and do when I work with clients, is trying to get them, when they buy a home, particularly if it's their first or second home, buying a home as much for investment reasons as I do for lifestyle. And what I try and do is tick both those boxes. Help clients buy something that's going to meet their lifestyle needs, but also give them a large amount of capital growth over time. Again, it's just a mitigating factor. We like to invest for pure investment, and obviously, again, a home's not purchased for pure investment, but it's probably some of the best tax-free capital growth that you can enjoy. So if you can get both, it makes sense doing so. Another problem with over-investing, so that is having a massive portfolio of lots of different properties, is it really doesn't leave you a lot of room to invest in other assets, which might be investing in the share market or making additional super contributions or reducing debt and so forth. Now, I know a lot of people listening to this podcast will be property investors and might prefer property over shares. But that's often an emotionally driven decision, and my view would be leave the door open for other investment assets. There are massive benefits of diversifying, so don't necessarily ignore that. If you're totally uncomfortable with other investment assets, that's fine. Don't invest in something that you're not comfortable with, but also don't be blind to really taking a more balanced approach to your investment strategy. So there you go. If you receive advice to invest in multiple properties with a very large property portfolio, just beware. Consider the debt considerations, consider the quality. Ask yourself, are we compromising on quality? Instead of buying 5, should I buy 2 better quality assets? And if in doubt, certainly what I'd suggest is get a second opinion from someone that's completely independent, that understands property investing and might be able to sort of balance out those risks. Going out and buying 5, 6, 7, 8, 10 properties is a very expensive process. So you want to make sure that it's going to be the correct strategy before you go out and do it and regret it in years to come. Okay, that's it for this week. Until next week, bye for now.